Hey, it's Jim, and this is level 1 of the CFA program, the topic on fixed income, and the learning module on fixed income markets for government issuers. We've had great conversations on corporate bonds. We know that corporations issue bonds as part of their wealth maximization strategy. We know that corporations use their operating cash flows to make the interest payments and to repay the principal. We know all about how a bond issue impacts the right-hand side of the balance sheet. We've even had great conversations on an optimal capital structure and Modigliani and Miller. But of course, corporations are not the only organizations and entities that issue bonds. So of course, this learning module is all about government issuers. So you have to ask yourself the question, just like we asked the question back with corporate bonds, why do governments issue bonds? And if the corporations issue bonds as part of a wealth maximization strategy for its shareholders, then you have to try to find the analogy over on the government side. But I'm guessing that you might say that governments issue bonds as part of a wealth maximization strategy for their taxpayers. I'm not buying that one completely. Governments issue bonds for just a simple reason, is they spend too much money. And so the answer is to finance budget deficits. And so this reading is a pretty short one, and we're going to focus on some terminology. But I think if you learn and understand the different types of governments, why they issue bonds specifically, and then how those bonds get repaid, you'll be able to fit this in to the financial analyst model under which we're going to have clients that want to invest in corporate bonds, but we're going to also have clients that want to invest in government bonds. So look at the LOSs there. So we'll describe all these different types of bonds. And then we'll talk a little bit about issuance and trading at the end of this LOS. All right, so let's start with national governments. A lot of times these are called federal governments. So what gives a corporation the right to issue a bond? Well, the board of directors and the corporate charter says something in there like, oh, this entity can borrow money. Well, the same thing holds true with a national government, a federal government. Somewhere in its charter, there's a line that says, oh, by the way, if our spending exceeds our tax revenues, then we can go ahead and borrow money. So there's that word sovereign. That means sovereign. That means, they have kind of ownership of or control of some kind of geographic area. And of course, the people inside of that geographic area. So they have the authority to tax. All right, so let's go ahead and answer that question that I addressed just a few moments ago. Why do governments issue bonds to finance their budget deficits? How do governments repay? Well, there you go. They have the authority to tax. And those tax revenues, and this is what's really important for this particular learning module, is those tax revenues, they depend on the economic activity, not only inside of the geographic boundaries, but also what's going on in the global economy. So how do we repay this tax revenues? But we also can impose tariffs, we can impose fees, we can have some kind of an enterprise revenue where the government owns some type of an enterprise, and the revenues generated from that will go to repay that bond issue. The purple one over there on the right is probably interesting and maybe more interesting to those of you who have accounting backgrounds. Of course, when we put together the financial statements for corporations, we have to use the accrual basis of accounting, but governments, they don't. Now compare that to our conversation on private sector issuers. I mean, my focus just recently was on the term corporate issuers. What did we say? Operating cash flow, right? We can sell our assets. And because we use the accrual basis of accounting, corporations use those general accepted accounting principles. Now, the first part of this learning module has a pretty good section on the difference between developed economies and emerging economies. And so to me, this sounds like a great exam question. What's the difference? The Institute could give you in the question stem a description of a particular country, and if this country has a strong, stable, and diversified domestic economy, if it has a transparent fiscal policy, if it's a major global currency, then you would assign that into the developed market category. On the other hand, if they don't have a diversified domestic economy, if there is secretive fiscal policies with their lawmakers, right, and if no one's ever heard of their currency, well, then it's probably an emerging market. But there are some good things about an emerging market. There's potential for high growth. Remember, we're going to have clients that have, let me just use my hands here. We're going to have clients that have, this much willingness and this much ability to take risk. So the developed market sovereign issues are probably more appropriate, but we might have clients who have this much ability and this much willingness to take on risk. And so these emerging market bonds have potential for higher growth, although they're going to have greater standard deviation or greater volatility. What do we have on the slide there? Less stable. Here's a key element that might show up in the question stem is that these emerging market economies and the governments running these emerging market entities are more likely than others to focus on infrastructure investments, things like roads and bridges and tunnels. Although for those of you living in the United States, if you've driven on the Pennsylvania Turnpike lately, you'll know that in some part of Pennsylvania they really repaved the roads and they're fun to drive, but other parts they're not. The distinction ought to be made between domestic debt and external debt. Domestic debt is exactly what you might think it is. It's a bond issue in the domestic currency, and it's held by lots and lots of financial institutions and regular investors like you and me, but mostly institutional investors. But sometimes when this debt is issued, and of course it's in the domestic currency, it is purchased by foreign creditors. Now, you might not think this is much of an interesting concept, but it's really important, not for countries like the United States, although this pops up pretty regularly, but and let me go back here real quick, for these emerging markets. So think about this. Suppose I'm the United States and I have, let me just pick a number. Let's say $30 trillion in outstanding Treasury securities. And let's suppose that 25 of those trillions in the securities are held domestically, but 5 or so is held by foreign creditors. Well, let's suppose that for some crazy reason that the U.S. economy is in some sort of extended recession and depression. So the government then has to decide, who am I going to pay? So of course, the decision then is probably to say something like, we're not going to pay these foreign creditors. So the distinction between domestic debt and external debt is probably not too important for developed countries, but it's super critical for emerging market economies, because those economies might say to your client or my client who lives in the United States or wherever you live, and that country over there might say, we're not gonna pay that interest or that principal. So that's probably a good exam question for the distinction between those two. All right, when a national government issues its securities, it represents pretty much the lowest default risk inside of that particular country. It's also the largest of the bond issuers domestically. If you do a quick search, what you'll find is that if you take a look at the total federal debt in your country, whatever it is, maybe it's this big, and if you take a look at the total corporate debt in your country, it's going to be that big, this versus this. So governments, what did I say earlier? They spend a lot of money, so they have to borrow a lot of money. So how do we determine the amount of federal debt? Well, look at that first one there in the green box. Is set by government spending versus the tax revenues. This is what I was saying earlier. So budget deficits, of course, increase borrowing. Surpluses decrease it. I can't imagine that there are too many countries out there that have a federal budget surplus these days. There's probably a handful, but it's probably a short time period. So on the exam, if the institute says, hey, here's a country that has a surplus, you can just put a little chuckle sign beside that and say, oh, that's probably not too realistic. Nevertheless, it's a great exam question for countries that have surpluses. They can use the surpluses to pay down that debt, which of course means less borrowing. And here in the United States, every once in a while, you'll hear a politician say, oh, the surplus that we have, I'm going to use it to reduce our total debt. So the question then becomes, how do we anticipate, how as good financial analysts do we decide whether or not a particular government bond is appropriate for our client? Well, this goes back to why the Institute is big on its economics learning modules. I mean, what have we learned? We've learned at the macro level. So there we go. Economic growth, inflation impacts, energy prices. I mean, anything you can think of that we learned back in that macro learning module. And then at the micro level, of course, supply and demand and all sorts of those microeconomic variables, all of those things combined are going to impact the debt forecast, which of course ultimately impacts the yield to maturity on these things. And don't forget about fiscal policy. So here's the spending versus the taxing. Now, governments can issue bonds and other kinds of securities over any time frame that it wants. I mean, the U.S. government could issue bonds next Monday. They could say, we're going to issue $500 billion in 500-year bonds that mature in 500 years. But typically what happens is that you have these short-term securities. They're called bills in almost every country out there. So treasury bills, 1 to 12 months. These are securities that do not make an interest payment. And so they almost always sell at a discount. So if you buy a U.S. Treasury bill that matures in 6 months for $10,000, you might pay $9,958 for it today. You won't get any interest payments in between that time period, but then at maturity, you'll get your $10,000. Now, I said that it almost always sells at a discount, and you should be thinking, well, Jim, when would a short-term bill sell at a premium? Well, go back and do a little bit of a history lesson. This has happened a handful of times in the United States, not least of which was back during the Depression and then after the 2008 financial crisis. Essentially what you're doing is telling the government, look, I have nothing better to do with my money. I will pay you to hold my money. So maybe we'll pay $10,100 for a Treasury bill, and in 5 months we'll get $10,000. So what did we pay? We just paid $100 for safe storage. It's kind of insurance. Almost all of U.S. Treasury debt is in the form of Treasury bills, but of course they can issue Treasury notes and Treasury bonds. They can have fixed coupon rates. They can have floating coupon rates. They can have inflation-linked coupon rates. They can have coupon rates that are linked to the performance of the U.S. dollar versus the euro. There are all different sorts of ways that governments can do this. And of course, there is that implicit guarantee. I mean, here in the United States, what do we know? The federal government guarantees. And so that's why we consider these things to be risk-free securities, default risk-free. They still have interest rate risk. That's an important concept. But lots of times what will happen, and this of course has happened in the United States, is that the federal government will come in and say something like, you know what, we're going to go and buy some of these other kinds of securities. Maybe I'll call it a mortgage-backed security. And implicitly in our buying those, the fact that the federal government owns them, there's an implicit guarantee, so it really lowers the yield to maturity on some of those other securities. We'll have great conversations on asset-backed securities, some other learning module. Now, the reason that the U.S. Treasury Department has what is perceived to be a default risk-free ability to issue bonds is that it has a perceived infinite ability to roll over the debt. And of course, if you read the Wall Street Journal, which you should be doing regularly, you'll read something like this. Today, the U.S. Treasury Department issued $500 billion in Treasury securities. 300 of those millions, or what did I say, billions, was used to retire maturing debt. This is rolling over the debt. So essentially, our Treasury Department has the perceived infinite ability to do this. I mean, essentially, you're just borrowing from this dude over here to pay off this older dude over here. But what governments try to do, they try to balance across maturities. They try to do that, but sometimes they're not successful. Now, recall back in our fascinating conversation about the right-hand side of the balance sheet for corporations that Modigliani and Miller in 1958 taught us in their capital structure irrelevance proposition that shareholders really don't care whether the firm issues bonds or issues shares of stock. And because of some really, really cool things, and that's for another learning module, but for some really cool reasons, that shareholders are indifferent between a bond issue and a stock issue, which means that not only does it not impact cash flows, but it's not going to impact value. That's why we call it the capital structure irrelevance proposition. Well, there's an analogy in the sovereign government market. It's called the Ricardian equivalence theorem. And this has a couple of assumptions in there. We have them in circles down at the bottom. That what happens is that today's tax cuts leads to future tax increases. And so taxpayers are indifferent between whether the government issues more debt today or less debt today, because that's going to have an impact on the tax rate. And whatever the government does today is going to be offset by a changing, either an increase or a decrease in the future. Now, of course, this Ricardian equivalence relies on many of the assumptions that Modigliani and Miller did. One of them is a perfect capital market in which there are no such things as transaction costs and bankruptcy costs, and of course there are no agency costs explicitly or directly inside of a government, but that doesn't mean that there are not indirect agency costs in there. And then look at the far right there, intergenerational altruism by taxpayers. Something like, oh, if the tax rate goes down today, we're going to save on our tax liability to the government, and what we'll do is we're going to save that money, we'll invest it, and then the future taxpayers will benefit because the economy will expand. Personally, I don't think this has a really good foundation for an exam question, but just remember Ricardian equivalence and Modigliani and Miller, and you probably should be able to get that one question. Now, what are the benefits of issuing sovereign debt, in particular longer-term sovereign debt? Well, it establishes a risk-free benchmark. Most importantly, what is the U.S. Treasury Department? Its longest maturing bond is 30 years, so that establishes a benchmark for the 30-year mortgage interest rate that financial institutions charge their homeowners, their borrowing homeowners. Now, of course, there's a 10-year benchmark that's probably just as important, maybe more important in the mortgage market as well. But just remember that it establishes a default risk-free benchmark. Now, we're going to have tremendous conversations in future learning modules about the need to hedge. And we can hedge in all sorts of different ways. But we know that, at least at this early stage in the CFA program, we know that there are all different sorts of risks. There's default risk. Now, when we buy these bonds, these treasury bonds, we don't have default risk, but we still have interest rate risk. So we use these sovereign bond issues to hedge market interest rate risk. And we can do that explicitly in the bond market, or we can do it in the derivatives market. And so look at that third one in the purple there. This is a scenario under which these treasury securities or the sovereign debt is used as collateral in those derivative markets, but also in the repurchase agreement market. We'll have great conversations about repos some other day. Now, of course, here in the United States, this is true. What the U.S. Fed and central banks can do this is that they can buy or sell government securities to either increase or decrease the money supply. So that's why we have monetary policy over in there in that far right-hand box. And then we can also worry about our foreign exchange reserves. Remember, financial institutions, and in particular, and in addition to central banks, they hold lots and lots of currencies out there to facilitate trade. Those are called foreign reserves. Now, federal governments are not the only kind of governments who have fun in terms of their spending related to their taxing. So non-sovereign governments, we can do this at a regional or a local level. Why do regional governments or local governments issue bonds? Well, for the same reason, because they have budget deficits, but they also have the ability to tax. So they're going to repay these bond issues based on their ability to generate tax revenues, but they can also, impose all different sorts of fees. Now, quasi-government organizations, these are organizations that they kind of look like a government, but they kind of look like the private sector. That's why we call them quasi. How about if I call them near government organizations? Look on the far right, they're considered less risky because they're quasi-government. They're associated with the government. They kind of look like the government, but they do have an implicit government backing. They serve a public need, so airlines or housing or student loans. All right, so in general, this is a good exam question here. Two types of municipal bonds. We call them municipal bonds here in the United States. Provincial bonds in other parts of the world. They're in general two types. General obligation bonds, and these are exactly what you might suspect. They are issued for general obligation purposes, for general public goods and services. Things like regular old roads, things like school systems, things like police and fire stations and libraries. How are these bonds repaid? They're repaid by the taxing authority of that local government. Most bonds are general obligation bonds. Revenue bonds, on the other hand, are issued for a specific project. And those specific projects are specific, right? They're unique. They're not general obligation bonds. So what are some examples of specific revenue bonds? Didn't I mention earlier Pennsylvania Turnpike? A couple of weeks ago, my wife and I drove to Brooklyn for a wedding, and we used our Easy Pass. And of course, when you use the Easy Pass, you have no idea what you're paying. And so I went to the webpage and I found out that we paid back and forth almost $100 on those roads. So you get the sense that I used the road, and so I had to pay the toll. And the toll revenue then was used to, to pay the interest, to repay the principal, and of course, some of it was used for maintenance. But revenue bonds also include what I always was taught to call industrial development bonds. These are things like sports stadiums. These are things like tunnels. These are things like water treatment facilities. So what happens, you have a government entity, a local government entity will issue a bond in conjunction maybe with a local utility company. So that bond, the proceeds of the bond then is used to purify the water, right, for irrigation, to whatever water companies do. And then the water company charges the users, and then part of that goes back to the entity to repay the bond issue. This has been used for, things like airports and hospital systems and all sorts of things. So just remember revenue bonds, specific projects. Now, suppose that there are organizations or groups of individuals that are located in different countries. But let's suppose that I am really interested in water purification. And let's suppose that there's someone over there interested in water purification, and then someone over here interested in water purification. So here I am, let's suppose I'm in the United States, and then let's suppose there's someone in Europe, and then there's someone in Africa. And so the three of us get together and we say, you know what, we ought to pool our resources. We would form a supranational agency. And what we would do is we would issue bonds. Now remember, these are three different geographies, three different governments. So we're not directly affiliated with our governments, but we're loosely affiliated with our nations, so to speak. So we form this organization and we can issue a bonds. And so look at the green there, promoting economic development, integration. I mean, you can do this for anything there. Examples are World Bank, the International Monetary Fund, Asian Development Bank, the African Development Bank. And what these supranational agencies do is they issue lots of bonds, and then they make that capital available to whoever's out there, well, promoting economic development and integration, like my water purification example. Now, look at the bottom there. It's backed by the member nations, but it's not risk-free. It's not default risk-free. That's super important. All right, how do we issue these bonds? What do we know? We know that corporations, essentially, they just pick up the phone and call the investment banking industry and said, hey, we need $5 billion. Can you help us? Right? And so the investment banking industry, they say, sure, we'll help you. And we have a couple of different ways to do this. But with government bonds, we're going to do this through an auction. What we do then is we say something like, hey, everybody out there, we want to borrow $500 billion. We want to do it next Monday. And tell us what you want. And so essentially what happens is that all of the potential lenders, they pick up the phone and they call the Treasury Department and they say, hey, I'll lend you $100 at 7%, or I'll lend you $17 million at 12%. So they collect all of these bids and then they do something with it. And so look down at the bottom. There can be competitive bids, which specifies price and quantity, which is what I was saying earlier. But if you say something to the Treasury Department, I'll lend you $100 million and I'll charge you 20%, well, you're going to go away empty-handed. But if there are non-competitive bids, you can make those same kinds of bids, but what happens is that the Treasury will accept whatever that, maybe it's an average price, maybe it's a final price, however it works, and then everybody that participates, everybody that makes that bid, that non-competitive bid, they're guaranteed those securities. And those bids, they can be a single price or they can be multiple price auctions. Now, under the single price auction phase, first thing government does is pick up the phone and calls everybody and say, hey, we need a bunch of money. And then these in the United States, they're called U.S. government security dealers. And dealers, what they do is they say, oh, here's some bids. And then the non-competitive bids, those are pretty much accepted. Non-competitive bids are ranked. Think about putting it in an Excel spreadsheet, and then there is a cutoff yield. And so those successful bidders then receive their securities in exchange for payment. So these U.S. government security dealers, what do? They have a special role. So they can say I could be a primary dealer. I could say to the U.S. government, I could say, hey, I'm Jim. I have a bunch of money. I want to participate in this. And so they would do a background check and they would say, you know what, Jim, you're a college professor. How much do you have? You have this amount? Well, you need to have this amount. So I probably wouldn't be appointed as a primary dealer. But of course, people in the investment banking industry are counterparts for central banks in open market operations. There's no way that I could do that, right? Facilitate foreign central bank transactions. So you can do this direct participation. How about the trading of sovereign debt? I mean, there's probably not a New York Treasury exchange like there is a New York Stock Exchange. So these are over the counter. There are some countries that have exchanges. These securities are always highly liquid because they're in demand because they have such low risk. We have on the run and off the run securities. These are probably good exam questions. These are definitional. So think about this. Suppose that the U.S. Treasury Department a year ago issued a 10-year bond, and it hasn't issued a 10-year bond in the last year. And then today it says, oh, I'm going to issue a 10-year bond. Well, that one that was issued a year ago, that now becomes the off-the-run security, and the new one is the on-the-run security. So think about this. Notice what we have in purple. Most recent, which is what I just said, highly liquid, makes sense because there's tons of stuff coming to the market. And so the investment banking industry and the primary dealers, they're going out and informing the investing public, hey, there's tons of these things out there. So highly liquid. And then this is important for us. They're the benchmark for yields. Now, who invests in sovereign bonds? Who invests in corporate bonds? Well, we all do, right? And so the question then becomes, which of our clients have the appropriate capital and ability and willingness to take risk to buy a corporate bond and to buy a government bond? So always remember how this plays a role in the policy statement. Now, of course, the U.S. Fed, they buy and sell U.S. Treasury securities to either increase or decrease the money supply. Also, central banks, they hold Treasury securities as part of their dollar reserves. Banks and insurance companies, they hold Treasury securities for their regulatory needs because you think about it. You're a financial institution. The federal government comes in and says, oh, you need to have this amount of cash on hand to prevent a run on the bank, and you need to hold these liquid securities. Well, it makes perfect sense then for financial institutions to hold these Treasury securities. Now, there's also a need for reserve currencies. What this simply means is that when there is this international trade in the foreign exchange market, a lot of times there is an exchange of US dollars for Canadian dollars. I mean, that makes perfect sense. But sometimes central banks and financial institutions, they just hold dollars or whatever is the reserve currency. They hold these as part of the reserve so that they can, look at the middle green point, used for global trade and finance, the US dollar. And I just read this recently. I can't remember where it was. It might have been in the Paul Volcker autobiography, that back after World War II, that the U.S. dollar was used as a reserve currency, 82% of the cases. Now it's down to, I think it's under 50% or so. So the euro or the British pound. And that takes us through those two learning outcome statements. What I want you to do now, you ready for this? I send you to the learning module afterwards. There's 7 questions on there. I'm going to go ahead and make a bold prediction that you can answer those 7 questions in less than 5 minutes. So go work on those. Remember what I said at the introduction. This is pretty much definitional. Just remember why the entity issues the bond and how it's going to be repaid. Hey, thanks for watching and have a great day. Good luck studying.